Okay.
Well, greetings everybody, and welcome to the final roundtable of 2020, that year that shall live in memories in a lot of different ways, most of them probably weak or bad. Welcome everybody to tonight's session. My name is Mark Robertson. I am joined here by our good buddy Cy Lynch from Atlanta. How are you doing, Cy?
I'm doing just well, thank you, Mark. Hope everybody else is.
And Hugh McManus may join us late tonight, but he's actually tied up. And as many of you know, he's on the front line of delivering vaccines to you. So we don't want to get in his way. We're also joined by my dear colleague, Ken Kabula, from what I believe is snowy but toasty Central Michigan.
Yeah, we just have a dusting on the ground tonight, not very much, and it's supposed to get real sloppy for the next couple of days. Rain, snow, freezing rain, ice, everything else. We're right in that narrow band between rain and snow for the next 3 days.
And my name is Mark Robertson, and I'm coming to you from down south. In fact, I'm south of Cy Lynch. We snuck down for a little getaway with our daughter's family. We did it as carefully as possible, following all instructions issued by Hugh McManus for the travel, but taking in a little bit of sunshine and vitamin D, because that's probably a good thing. And we do want to, I mean, it is just the flip of a calendar page going from one year to the next, but like Herb Lemko was just saying, we leave the back door open, kick 2020 out into the backyard. Some of you actually tendered the thought of kicking 2020 to the curb to make sure that the job is complete, and welcoming 2021 and whatever mysteries and challenges and opportunities it holds for us as investors going ahead. So that's kind of our theme tonight, 2020, 2021, and then that magic number we're going to talk about in a few minutes, 22.2%. But for now, we'll raise our glasses to what's been another very successful year for us as investors, and get the program underway. All right, here's the standard disclaimer. No investment recommendation is intended. We are definitely going to be talking about some companies tonight, specific companies with current thoughts and analysis. Everything that we do here is an educational demonstration. It's a demonstration based on the principles and methods, techniques of the modern investment club movement, whether it's as has been laid out by George Nicholson and the National Association of Investors, now known as Better Investing, or the interpretation or the methods promulgated by Manifest Investing. We think they're the same thing. The views that we express here are our opinions, and we do try to disclose when we have a stake in a company that we're talking about. If you'd like to be added to an email reminder list about this event for future roundtables, send an email to nkavula1@comcast.net, and Natalie will make sure that you receive a couple of reminders every month. We do get together every month. They are most often, 90% of the time, on the final Tuesday at 8:30, just like tonight. So that's what we do. You can also go to the Better Investing page, seek out the Mid-Michigan chapter, and take care of it yourself, self-service, setting yourself up for that email reminder. If you'd like a copy of the slides, or if you have follow-up questions or suggestions for us, send an email to markr@manifestinvesting.com, and we'll see what we can do to pursue whatever's on your mind. All right, Ken and Cy, here we go. You may join us in a few minutes, but this is our standing agenda that we've had now for 10 and a half years, coming up on our 11th year of operation, doing this on a monthly basis. We will spend some time just kind of laying the groundwork, describing some of the track record of the roundtable, but big welcome. It's a big audience out there tonight. There's a few new names. Big welcome to you. We try to keep this informal. We keep the microphones open for those of you that have that type of audio equipment, and you can also submit questions through the questions tab on your control panel. We don't have a lot of hot seat stocks. We have a couple of stocks that are actually being acquired and giving us a pretty good reward for that. We'll talk about those in a few minutes. You can see the companies that have been selected to be presented tonight. Ken and Cy will be presenting some old standard, I'm not going to say stale. I don't want you thinking that these could be stale ideas, but some fairly good blue chip leaders there that are no stranger to anybody. I, on the other hand, am going to take us on an adventure with ACOPF. That's A2 milk, believe it or not. And Hugh may come along to throw another one of his less traditional selections at us. If you are joining us for the first time, we do an audience poll after the 4 stock presentations, and you are welcome to vote in the poll. It is secret ballot. You don't get to vote as often as you want if you're from Chicago, and we count them faster than they do in a few of the states that have been in the headlines here in the last few months. All right, so in the discussion, if we have any time left over, we'll invite Ken to share some thoughts on simplicity and elegance, a theme that he talks about at this time of year, and it's an article that we've shared at Manifest Investing here over the last few days. It's just beautiful talking about how things stand the test of time, and just a wonderful thing. And if we do leave a little bit of extra time for wide open Q&A at the end, we will try to do that. And we probably will have a little bit of extra time tonight in this year-end session. Here's a quick reminder as to what we've been doing. We've been doing it for over 10 years, 10 and a half years now. We're here just to share an idea in how we, as part of the community that is the Modern Investment Club movement, looks at that opportunity and decides whether or not it's actionable or not. Please do your homework. We do welcome non-core selections, less traditional ideas. Things like Hugh McManus selecting Amazon come to mind. We'll actually show you. We split the portfolio into core and non-core last month, so we'll revisit that this month a little bit. We do keep track of every single recommendation, and we keep track of the overall portfolio performance using a standard rate of return calculation for the tracking portfolio. We'd like to see that beat the total stock market as measured by the Wilshire 5000 index fund, and we're right at that at the 10.5-year mark, beating it by 5 percentage points, and we'll actually show you that. We would like to see as much as 60% of our selections outperforming the total stock market index. We're in the 52% range right now, but we do keep track. That's the message. All right, did want to spend just a moment on this slide. It's one that we've kicked around. I think, Ken, I promised earlier today that it was the last time we're going to talk about it. This is probably the last time, but I might even break that rule a month from now. Who knows? We're basically taking a question that we had received from an investment club, and we featured it at some of our bull sessions. We talked about it a little bit in different ways over the last several weeks here at the roundtable. And they're just basically pointing out that within this community of investors, there are a number of outperforming groups or collections of stocks. And that's so cool when you see it happen. And starting with, let's start with average investors. There are no average investors here tonight. They're all off doing something different, chasing hot stock tips and looking for hot stock tips in magazines. So what we've done here is collect up these various groups of stocks, or again, investment clubs or whatever, and characterize the performance. Again, this is a Dalbar number for the average investor, and pretty weak performance compared to everything else. The total stock market we do measure with the Wilshire 5000, and over the last 5-year period, that has checked in at about 15%. It's been pretty hot. It's been riding the Apples and Microsofts and Facebooks pretty hard, and doing pretty well. You can see that the value line arithmetic average, another broad measure of the stock market, basically our benchmark for all of the above investing, has been doing okay, but not quite as well as the total stock market. So again, what that is telling us is that there is a wealth of opportunity in the medium and small size companies. And we've been discovering them over the last several months. We've been trying to feature them at the roundtable, and lo and behold, over the last quarter, the medium and smaller companies have actually started to kick into high gear, and it could be a wonderful thing to watch here over the next year. Tin Cup happens to be a model portfolio we've been running since 1995 at Manifest Investing. That checks in at 17% over the last 5 years. You can see that the BI total return for the 100 most commonly held stocks at Better Investing checks in at a pretty decent number, very close to the stock market performance. And the Manifest 40 represents the 40 most widely followed companies at Manifest. They've been doing pretty well. But the number we really want to focus in on is over the last 5 years. The roundtable is checking in at 22.2%. And that's just a whole lot of good, clean fun. Thanks, gentlemen. Any thoughts or comments?
Mark, I have a question that's coming from a number of the folks in our audience. Do you know any way that anybody could invest in the BIX or in the BIXR?
I'm not aware of one. Somebody in the audience might be able to share on that. I do know that it is tracked as an index. I'm not aware of any direct investable method.
I'm not aware of any. I know that was, it was established both as a tracking mechanism for publicity and the like, and I think there was certainly hopes that someone might pick it up, but I'm not aware of anybody that has picked it up as a investable option.
I do think
I know.
Go ahead.
I know that right around the time of our name change, when we went from NAIC to becoming Better Investing, there was an effort made to create the index, the BIX index. And I know there was talk at that point about perhaps coming up with a fund that you could invest in, but I don't think it ever went anywhere. So Don, I don't, and the rest of you that have asked this question, I don't think that there's anything commercial out there that will allow you to reap this reward short of you creating the index yourself, and that would be a very difficult thing to do, I think.
Yeah, there were a couple places, and some of those places that would do like model portfolios. The name escapes me, but it wasn't Folio, but it was like Folio. And but those have actually gone by the wayside. Jason Ramage used to talk about a couple of them where you could basically demonstrate a methodology, and you could basically put together a basket that was the BI 100. But don't feel like
yeah.
I mean, the other thing I would point out is
the only thing that I throw out, and this is for somebody to investigate on your own. I just know that there are things that are going on. Schwab, and I think their stock slices may be limited only to the S&P 500, but that might be a mechanism potentially to try and construct your own that you could do without having to actually buy 10, 20, 100 shares of each company. And I know that I have seen an ad or two of Fidelity's kind of answer to that. And I'm not exactly sure what their procedure is either, but you may want to look at I know Schwab calls them stock slices, and I'm not sure what Fidelity calls them.
Yeah, and both of those companies are trying to ingest those other portfolio companies or basket companies that I was talking about. I don't
Mark,
know.
we are getting a comment, Mark, from Joe Farrell from the La Miz chapter, Louisiana, Mississippi chapter, and he says that there is a folio on the Folio brokerage website that advertises itself as following BIX. So you might explore the Folio brokerage site and see if there's something that mimics the Better Investing Top 100 right there.
Yeah, and make sure you're up to date on all the goings on at Folio too. I've been hearing stuff.
Okay, and then Mark, one more follow-up. Is there any reason why the S&P 500 or the NASDAQ or the Dow is not included on this chart?
Well, those are going to very closely mirror the Wilshire 5000. They're all cap weighted, and they'll all basically fall into that same camp, especially over a time frame of 5 years. They're not going to be dramatically different than that Wilshire 5000 slice.
The S&P 500 definitely won't be.
Right.
Yeah, and there's literally tens of different indexes out there, and I think space more than anything else kind of limits us we're comparing right now.
You bet. All right, and just one last comment about the question and the interchange we had with some of these investment clubs as we were talking, and they seem to be almost obsessing over this notion of it being two different approaches. And I just don't feel that way. I mean, maybe I'm wrong, but I don't think so. Everything we do at Manifest Investing is inspired by the stock selection guide and George Nicholson, period. We do focus 100% on the preferred procedure. That's a little different. But the one thing that we do a little bit different is in that reference on the left, that Oh Captain, My Captain, the Robin Williams reference to Dead Poets Society, and basically be willing to think differently. We describe why you might want to consider embedding forward-looking estimates on a more routine basis into your studies. And frankly, we think it's urgent. We do it for every single stock we cover at Manifest Investing. The other thing is our emphasis on the small companies, the best small companies, and as Ken has really driven home this notion of you don't have to settle for broken down roller coasters with small companies. You can find high quality, best small companies. And I think that's a big part of our successful track record. That's definitely a part of the roundtable question. Would you agree, Ken?
Absolutely, Mark, that, ask of your small companies the same thing you ask of your larger companies. Don't settle. Buy the best. I'm just pulling quotes from the investor's manual and screaming them across the airwaves. Continue to look for the best, whether it's a small company or a large company.
Absolutely.
Yeah. And I would also say it's not a methodological difference. You hit on I think a couple of tweaks that Manifest has added to the better investing methodology. But I do believe that that Manifest provides both a methodology and the tools to follow a portfolio management methodology that is not offered directly by Better Investing. Now you can incorporate the methodology, using your SSGs and everything else, because of course, as you just said, Mark, Manifest is SSG driven, but the actual methodology and the tools that's a Manifest innovation, and I think a tremendous contribution. Now, interestingly, the roundtable doesn't strictly follow that because that's the nature of the roundtable. So it would be kind of interesting to actually wonder how much better the roundtable could actually do if we ran it as a portfolio managed.
Yeah, we'd have to do things a little bit different.
To just a track.
But
yeah,
I will push back, Si. You kept talking about we were letting the par overall return forecast of the portfolio drift down and down without taking care of it. We've begun taking care of it, Si, and you were a big catalyst in doing that, and it's made quite a difference. That's a subject for another time, but it's not insignificant. Here's a look at the relative return over the last several years. You can just see it on a month-by-month basis. Again, the rate of return on the portfolio is 18.2%. The rate of return on the Wilshire 5000 in matching investments would be 13.3%, so that's approximately 5%. We've actually dipped right beneath it a little bit, but we've been in the promised land for several years, and we do hope to stay there. The market's been kind of hard to stay ahead of by 5 percentage points here over the last little bit, but we've been cranking along pretty well. And you can see that the outperformance accuracy, more than half of our selections have beaten the market over since their time of selection. And we've actually got taken out $60,000 more out than what we've put in over the years, and still have the balances we're about to look at. So the relative return, again, is nothing more exotic. It's not magic. The relative return, some people call it an excess return. Some people call it alpha. All it is the actual return in your investment minus what you would have gotten in a benchmark investment like the Wilshire 5000. And we're trying to stay above zero. The goal of most investment clubs is to aim for that 5% level and be happy if you get close to it. And many investment clubs end up in that area between 0 and 5, and there are many that end up in the 5 to 10, and there's even a few that are above 10 for a significant number of years. So it can be a lot of fun.
Just to be clear, Mark, that 22.2 number you were referring to on the last slide, that was a 5-year return.
Right.
This 18.2 is a 10+ year return, almost an 11-year return. So they're different time frames, and that's why the numbers are different.
Yep. In fact, that's one of the other takeaways that I should have mentioned with that question. Anytime you're making performance comparisons, you have two choices. You can either make them all aligned to the same period of time, or you can use a relative return to make a comparison, but you can't use different time periods, as the question basically stumbled into. All right. A month ago, we broke the roundtable tracking portfolio into two pieces, core and non-core. We are channeling our friends, the Plungers. That's an investment club in Michigan. They actually did this and remained in operation. They actually do put crime scene tape down the middle of their dining room and sit on opposite sides. Part of the club takes care of core, and the other part of the club takes care of non-core, the friskier type investments, the type of stuff that you see on the right. And they are two different animals. Ken's up straight and parallels on the left, and Hugh McManus is pretty well entrenched on the right-hand side with some of the stuff that he is inspired to bring our way. Any comments or questions on that, Ken?
Yeah, maybe we should put at the top of this slide, Mark, as we continue to use it, that the core, the writings and everything we've talked about this core non-core idea, we've always talked about somewhere between 70 and 75% of your portfolio being focused on core, and then that leaves 25 to 30% that you may focus on non-core. It's not necessary to divide into non-core if you're not comfortable there. We know many clubs and many individuals that are completely successful and comfortable sticking only with core stocks. I don't know as many successful investors that stick with 100% non-core stocks.
That's a great point. I'm not sure I know any, but maybe they're out there. All right. So as we said, we've basically broken the portfolio into two pieces. The old roundtable portfolio, by the way, you can access it right there at that link. That's a public link. And what you're looking at are the stocks that we consider to be core. What these are typically going to have is high quality, high financial strength. And I think the real killer for the tiebreaker as to whether something's core or non-core can often be the earnings per share stability. That would be the straightness of the trend lines in the historical data in a visual analysis. And when they start going all over the map, we recognize that as non-core very, very visually. So what you're looking at here are the top 20 holdings by percent of total assets, starting with Microsoft, just to make sure that everybody understands how the numbers are generated. Up here in the legend, when you see Microsoft mentioned 5 times, that means $5,000 has been invested, and it's now worth $56,800. And so the repeats are the number of times that $1,000, we invest $1,000 into any company that we select, whether it's one of the 4 of us or a guest knight or a guest damsel or the audience vote. And that's what the portfolio looks like. A lot of household names. There's a few that are a little less household names, but that's what the core part of the portfolio looks like as of tonight. A little low on the projected return, maybe something we want to think about, maybe a little bit low on the growth. So we want to be constantly adding high quality, faster growing companies to the portfolio. Here's what the non-core looks like. Again, these can follow a completely different set of rules. These could be turnarounds. They could be very early stage companies. I'm not sure Ardelyx, the second one there, even has earnings yet. I'm pretty sure they don't. So these are definitely non-core and / speculative. But the $7,000 invested into Ardelyx is now worth $14,000. The $2,000 invested in Amazon is now worth $22,000. $100,000. So that's how you break down that code. Notice the lower earnings per share stability, the lower quality, and all that kind of stuff. And Ken, I do think we'll go ahead and swap Dow over to the core side, unless there's any objection.
No, and I think at some point we're going to have a discussion about Amazon as well.
Yeah, it's coming.
Whether it's core or non-core. But I agree with you with Dow. I think that even though Dow has very little history in its present form, I think it's the kind of stock that you can build a portfolio around. And I believe that Dow probably does belong on the core side of the tape.
You know, some of you are probably wondering, well, what's the big deal? The big deal is that we treat the two portfolios differently. We hold these companies to a higher standard, sell them, be a little bit quicker to sell at a higher return forecast than we would for the core holdings. The core, we're basically going to wait for the projected return forecast to get down to money market rates, and so that's why it matters. There are two companies on here, Biotelemetry and Cardtronics, that have received premium buyout offers, and that we'll need to talk about those a little bit. So let's go ahead and get these out of the way. There are no companies that would qualify in the core portfolio or in the non-core just on the basis of their return forecast as of tonight. And we also don't have any rule of 5 holdings. There's a couple that are on the ragged edge of being close to lagging the market by 20%, and we'll talk about one of those when they actually happen. We do have a position with a relative strength index greater than 80. That's our trigger to discuss possibly selling a company. Well, the reason it's above 80 is because it did receive that premium buyout offer. And I believe the offer was at $72 a share, and it's been floating around at $72 and change. But we've had a pretty good run with Biotelemetry. Is that a one-time selection? It is. It's a one-time selection, I believe, by Kim Butcher. And we'll take that any day of the week. So I think at 72 and change, Ken, would you like to discuss whether we sit and wait for that or if we take our money and run?
Yeah, there's a couple of different things that can happen at this point. If the stock is trading up near what the offer is, we're probably going to be waiting a period of time, I don't know, 4 months, 6 months, 8 months, until the deal actually closes. And for that period of time, if the deal is going along and then finally settles, the money that we have invested in Biotelemetry, that 3,000 plus, that's probably dead money. It's not going to increase very much because it's already moved up close, right smack on top, or maybe even a little tiny bit above what the offer for the company is. The second thing that could happen if the deal doesn't proceed as normally would be that the deal falls apart. If that happens, Biotelemetry immediately falls back to the price somewhere where it was before the deal was suggested.
Probably down around 50, yeah.
Yeah, that's not a very good forward-looking way to think about the company either. The third possibility might be that somebody steps in between now and when the deal closes and makes a better offer. First of all, that's not an extremely common occurrence. If that does happen, then you do have the possibility that there'll be a bidding war, and you do have the possibility that it's going to go higher than that lower 70s where it is right now. My philosophy is a bird in the hand, you know, ... You can all finish the saying. I think that it's probably best to take these offers when they've been made. If the deal falls apart, you still like Biotelemetry, then jump back in 6 months from now at 50. If it goes up, then you've made a loss, and you wipe your tears and you continue investing. But I would rather sell Biotelemetry, and the same reasoning with Cardtronics. That's another $1,600. If this were a club, we'd be able to take that money then and reinvest it. For the tracking portfolio, essentially what we're doing is we're locking in two nice gainers because neither one of them represents that much of the portfolio.
Yeah, and these are, I believe these are both Kim Butcher selections and single time selections, and this is where her middle name Kaching comes from. This is nice.
Yep.
Too bad she's not here to enjoy it as we clink our glasses together and push forward. But yeah, I think we take the money and run and just say Kaching.
Generally, I agree with everything that Ken said, and my approach when stocks I own have a buyout is kind of my test is what is there a benefit to holding, a known benefit, potential benefit to holding. In other words, is the stock currently trading underneath the potential buyout offer? Which usually doesn't happen. Normally, if that's happening, the market is telling you they think the deal's going to fall apart. Is generally if there's a very big thing. And
absolutely.
And similarly, if the rumor mill says that there may be prospective bidders out there, that's usually when you see the stock trading for more than the buyout offer. So when it's kind of right at the buyout, I generally say take the money and run.
All right, so let's go ahead and take the money and run on those two positions and trudge forward.
Mark, before I start my presentation, I'm going to unmute David Moore, who has his hand up. David, you'll have to unmute yourself at your end because you're muted at your side. David, you're self-muted. You'll have to unmute yourself. Okay, I'm going to count that as an inadvertent hand, and I'm going to go ahead with my presentation then.
Yeah, we can always come back to him later.
Okay. I just like Cy and Mark, I like to explain a lot of times where I come up with my ideas for adding stocks to the round table. I'll tell you first of all that I was looking for a stock that would be relatively new to the round table, that maybe we haven't looked at in a long time. And at the same time, we're at the end of the year, so I'm a dinosaur when it comes to reading material, and I read lots of magazines. And in my Fortune magazine that came just, I don't know, 3 or 4 days ago, there was a new list. I'm enamored with lists, and this list was called the Future 50. And they were looking throughout the world for the 50th fastest future growth possibilities that existed. Now, they were looking into the future. They were trying to gauge which companies would grow the fastest in the next 5 to 10 years. And this again was worldwide. Mark, if you can click once. Here's the top half of this dashboard, the Fortune Future 50. You can go to fortune.com and you can find this list, and then you can create this dashboard yourself by just typing in the tickers. And I use the feature in Manifest that allows me to put $100 on each one of these stocks. You can see that it's a relatively new dashboard because most of the stocks are still valued at just about $100. I think at this point it only traded maybe for 2 or 3 days. I've ranked the stocks. Well, first of all, there's 9 stocks out of that 50 that are not traded as ADRs in the US. So you'd have to go overseas, go to foreign stock exchanges to actually purchase 9 of these companies. But there are 41 of them that are either trading in the US as ADRs, American Depository Receipts, or they're United States companies to begin with. And so I put the 41 companies onto the list. I sorted it by par, and then I just started to go from top to bottom. I disregarded the first 2. They were out of the sweet spot, more than 10% above where my par was. Remember, my par is nothing more than the average return of all the stocks in the database, and it's down around 6%. So these were just maybe a little bit too good to be true. So I went down to the first stock with an actual green number. Green number over in the par column signifies that we're in the sweet spot. So we're somewhere 5 points above the average, up to around 10 points above the average. That's a really nice spot to find stocks to take a look at. I rejected Tencent and Pinduoduo. I don't like to try to evaluate Chinese stocks. I don't make any effort to evaluate Chinese stocks at this particular time. I know that might be losing me some money, but I just, at the moment, am staying away from Chinese stocks, so that eliminated them. That takes me down to Vertex Pharmaceutical. That was kind of an interesting story behind the company, but the quality was so low that I didn't feel it deserved to go into the roundtable tracking portfolio. And then that brought me to an old friend, Adobe. Now, Adobe got labeled early on as being old tech, but I think Adobe is anything but old tech. And I think Adobe is proving to be quite an adaptive and quite a revolutionary company when it comes to things that we use on a regular basis and that we couldn't get along without. I mean, try doing a lot of the work that we do on computers today without PDFs, for example. Well, that's an Adobe product originally, and we're lucky that it's been shared with the world, and they've allowed us to have this feature that can trade documents from one platform to another without a lot of effort and a lot of detail put into making the thing look the way it should. So I decided I would look at Adobe. That's a great par for a pretty large company. It's a wonderful quality. EPS stability, not quite as robust as I'd like it to be, but financial strength at 83, which says to me that this company has a long way to go before it disappears due to bankruptcies or anything like that. So I decided I was going to add Adobe to the portfolio. Next slide, Mark. Next place I went was to Manifest real quickly, just to check on that par value and that quality. And of course, I had seen them both on the dashboard that I had prepared, so there was no surprise. But I do like to look at this chart that falls at the bottom of every one of the sheets for each of the stocks in Manifest. This is called a chronicle, and it's a little bit busy to look at the very first time until you really know what it is you're looking at. My first glance is at the blue line. I would love to see it stay above 80, and this blue line, except for just a real short period back around 2016, has stayed above 80. I don't want to see any long periods of declining quality, and I don't see that. I see a little bit of bouncing around between maybe 81 and 88, things like that, but that's a relatively small gyration and I don't worry about that too much. So this passes my first test. The quality is pretty good and has been pretty good for about the last 4.5, 5 years. I then like to look at the red line, and the red line is par. I would like to buy this stock when the par is at one of the higher places in the history that I can see. So I know that last data point way over there to the right is at the end of November, and that data point is about 12.4 or 12.5. In fact, if you were to hover when you're actually on the site, you can get a read on what that last data point was. Well, I'm looking at the par right now. It's 12.9. So it's almost up to that 13 number. I see where the 15 is, and I'm reading across the graph, and I'm saying to myself, you know, except for that one place where Mark has circled, this is a pretty good par to be looking at this stock at. It's a high value over the last 4.5, 5 years. And so it's met the second criteria that I look for on the Chronicle. So it stays on my list of let's present it as I move to the next place. And the next place I like to go is to Morningstar. I like to see where Morningstar thinks fair value is. This was prepared, the slide was prepared this morning with last night's price on it. So yesterday's close was near $500. Fair value was $500. But what I find more important when I'm reading the Morningstar situation is this economic moat. I really like to look at a company that has a wide moat or at least a narrow moat, because that tells me how apt it is to be influenced by a lot of competition. A wide moat means it's going to be extremely difficult for any company to kind of push Adobe out of the markets that it has right now. On top of the wide moat, it's given an exemplary stewardship rating, which means they think that the management is doing one heck of a job in keeping this company moving forward. So that passed the Morningstar test for me real quickly. The next place I went to was Value Line. Next slide, Mark. And I noticed that the business was divided into 3 categories: digital media, digital experience, and publishing. And I really like this R&D number, this research and development number. Roughly 17.5% of total revenue in fiscal 19 was devoted to research and development. This is a company that is serious about developing new things and then putting them out there for its customers to use. I also like the fact that it had almost $4 billion in cash sitting on its books and a very small amount of debt compared to that almost $4 billion that it had in cash. So for an acquisitive company, and Adobe is a fairly acquisitive company, they make a lot of small purchases on a pretty regular basis, and they're able to turn those purchases accretive to their bottom line pretty quickly. So with all that cash, almost no debt, they're in a position to continue their acquisition if they find something that they think will contribute to what they're trying to do. I'm going to make the point that Adobe had tried to move into advertising over the web through the cloud and marketing, those 2 fields, and they're slowly going to leave the advertising to the people that do advertising better than they do, and they're going to focus on marketing, which is going to give many customers, and their customers are not individuals, their customers are corporations, other businesses, but the marketing is going to give these customers of Adobe the ability to actually run a lot of dynamic searches and tests for what kind of advertising works in what kind of situation. There's a lot of analytics involved in their marketing tools, and Adobe is going to plan to make that business grow, and right now it's one of the fastest growing units that it has. Of course, they're known for their digital media. Most of us know some of the Adobe products that are out there, and they've changed their model from a buy the software model, which used to be the norm for most computer software, and today they've moved to the same model that many other larger software companies have moved to, and that's a subscription-based model. It's easier for the customer to get in because the dollar amounts that they pay are less, but the revenue stream is continuous, and with this wide moat, Adobe finds its customers to be extremely sticky. They stay with the product and they renew and they renew, and that's a good thing for everybody concerned. Next slide, Mark. Here's the lines since 2014. We're certainly in a up straight and parallel situation. There's a little bit of a tax advantage on the earnings per share in 2020. So you might adjust that blue line down a little bit towards the trend line if you want to. They did have a one-time tax advantage in the fourth quarter of last fiscal year. So that number is a little bit higher than we might expect. But all in all, the trends are pretty decent, and you can read those trends. I did knock off 2011 so that I could make those trend lines lie very close to as much of the recent data as I could. And I found that the sales had been growing, at least for the last 5 or 6 years, at somewhere around 16 or 17%. And I was amazed to see the earnings growing upwards of 40% for that same time period. I did a lot of looking at other sources, analyst consensus, reading different objective ideas about how the sales and the earnings were going to move going forward. And I settled on 14% sales growth, 17% earnings growth going forward. They certainly have demonstrated that they can grow earnings faster than sales and do it over a fairly decent period of time. I love the pre-tax profit margin trends. The return on equity is just downright stupendous. The debt is a little bit higher than I might like to have, but again, with all that cash on the books, that debt is very easily handled. Next slide, Mark. This stock does carry a fairly high PE, and I settled on 50 as the high PE at the high side and 30 as the low PE on the low side. That gives me an average PE around 40. The analyst community is sitting with an average PE at 50 or even 52. So I'm considering a much lower PE, although it still is very aggressive for the way that I usually put an SSG together. But I'm asking myself, when's the last time that Adobe really moved below 45 at the high side and below 20 at the low side? And you have to go way back before the chart to find those kind of values if they exist at all. With these numbers trading at Monday's close, I'm getting a 4-to-1 buy. I'm getting about a 13.5% return, maybe going as high as 19%. That compares quite favorably to the around a 13% return from Manifest. So I feel I have a fairly solid SSG. And with that, I'm going to suggest we add $1,000 in Adobe stock to the roundtable portfolio.
All right. Well, thanks, Ken. We'll definitely be taking a look at that. I think we committed in bull session to perhaps looking at some of the wide variety of opinions out there and trying to dissect them a little bit in a future session. Thank you. All right, Cy, let's go ahead and talk about chips.
All right. These are kind of like Lay's chips. Nobody can eat just one or take just one. And Intel, like Adobe that Ken was talking about, is a long time most, if not all of us, touch Intel some way or other, or are touched by Intel. The one way maybe you avoid that is if you're completely Apple centric and you don't happen to have an Intel driven Apple, but even those for a period of time were pretty much Intel chip driven at the PC level. But like Adobe, it has adapted significantly and remade itself. And I actually saw Adobe out there as well, and just didn't quite wish to rely on the 50 PE. And that's one thing that kind of attracted me to Intel, and we'll see that in just a second. Here's what Intel looks like. It's a slow growing company, but a good steady growing company, as shown by the top line there in the green. It is a bit more volatile on the earnings and profitability side, as you can see at the bottom. That's the way chip makers have always performed. That's the way Intel has always performed. My quick screen, notice that Value Line's low projected return is about 18% over the next 5 years. So that just said this is something to look at. Also, I don't mind looking at the little bit shorter mid-range return that that Value Line now provides us, the 18-month, and they're saying 25% return, which if you just do a real quick in your head, cut that by 2, even though it's 18 months, just say that's a couple of years out potentially. That's running a potential 12% or so return over the next couple of years, which again is right in line with our goals of 15 or greater in just kind of a quick screening mode. Next slide. I decided to look for a new holding, and this month I went to the base manifest company research page. This is what comes up when you open a company research screen. It's the sweet spot screen, looking for stocks in the sweet spot that are high quality companies. A good starting place for screens or for stock studies. And this time it was, I decided I would use it. Notice it's relatively populated by banks. I've been looking at the banks and financial industry the last several months, decided I'd leave that sector and industry this month. So I crossed the banks off. I also was looking for a new holding. So Bristol Myers and D.R. Horton didn't meet that criteria. And that left Intel and Meritage Homes. And I'm not quite yet ready to make the residential construction leap. And I knew Intel. So I said, let's take a look at Intel. The other thing that attracted me to Intel, notice I actually didn't put the arrow here, but this list is ranked by projected PE. And notice that Intel has a projected PE of just 11 on this list. And again, given the rather frothy markets we're in, and particularly for a slower growing, some might call stodgier company, I again like to have a low PE to give me some margin of comfort and even potentially margin for error, you might call. Notice the quality all the way around and the outstanding financial strength. Next slide. So who is Intel? Again, we all know the name. We all have been touched by it at some point in time. I'm not sure we all know exactly what Intel today is. This is from their website. We create world-changing technology that enriches the lives of every person on Earth. A nice lofty sounding theme, but as we'll see when we poke that a little bit harder, that at least the scope of their touch, I think that's relatively accurate. As far as the world-changing quality and that sort of thing, that's for customers and investors to decide on your own. Next slide. They're focusing on data problem. And basically, they're just showing here that data is growing and expanding at a tremendous rate. And the challenge is to be able to use that data, analyze, understand, et cetera, et cetera. Think of what Intel's seeking to do as what we try and do using our better investing tools. We're inundated with data about potential investments and try and be able to analyze it and put all that data into a useful form. That's what Intel is saying the challenge is. Next slide. And they've just kind of gone through the way that data has been processed, if you will, and I might even call trends over history. In the 80s, we were digitizing. Then in the 90s, everything was getting networked. Then we hit the mobile trend, then the cloud trend, and now it's distributed intelligence, or the intelligent edge. I think Intel uses that term I'm not sure they do in my slides, but they do in discussing what they do. And essentially, think of that of everything. That's the Internet of Things, your smartphone, your smart light bulbs, your computer, your mobile device, your smart car. I just purchased a new car, and I'm astounded at the digital and technology things in the car. I don't yet have a refrigerator that talks to me or that I can talk to from the grocery store, but that's out there in the Internet of Things, and stoves and everything else. That's what the intelligent connected devices are. If you can name it, somebody's trying to give it a brain through computerization and chips, and that's what Intel is seeking to get into. Next slide. They have historically, Intel, of course, is a PC-driven business. That is still about half of their revenues, but they've been transforming into data-centric businesses that's data-oriented. Cloud computing was one of their big areas, but they're, again, in the Internet of Things. They have chips, of course, for mobile devices and mobile infrastructure, as well as one of their better performing segments in the last quarter was their Mobileye division, which is, again, automotive related technology. That's what Intel calls their data-centric businesses. That's their growing business, and now is about 50% of their total revenue. Next slide. And here's what they're looking at opportunity. The TAM stands for total addressable market. It's what is out there that Intel can seek to gain their business. You see the revenues of about $35 billion in 2018 in the PC-centric business, and there you see the addressable market of about $68 billion. Again, not a fast growing, and Intel already has a huge chunk of that. On the other side, the server side, more their data centric was $17 billion, and they're saying in 2023 there's easily another 15 or 20 times potential growth there that they can address. Next slide. Here's just their latest full year outlook of revenues, operating margin, and earnings per share. They're projecting a little bit down for the year. They're flattening out. The two big things that have slowed is the PC business has grown a little bit, probably driven by more home offices and people working from home and education from home. The problem is the margins have kind of fallen off a cliff. People have shifted from higher, more advanced, higher profit margin chips into lower margin devices in that business. The data center itself, which is the cloud computing and some of that, they took a bit of a hit in the third quarter, which I think gave the buying opportunity. At least that is Value Line's analysis. The reality is that the third quarter, Intel beat Value Line's projections, yet the stock fell significantly because of concerns over the data center operations. On the other hand, the Internet of Things, the Mobileye, and non-volatile memory grew double digits and made up a good bit of that data center group, which is about 30% of their revenues. And then the other segments that I just mentioned are the remaining 20% or so, but they're very fast growers. Next slide. So the judgments that I applied, I projected sales to grow at roughly what the 10-year average is. It's actually been growing at about 6 or 7% over the last 5 or 6 years. But again, you saw how Intel is a bit of a cyclical company. I don't think that's going to drastically change, because they're still a chip silicon-driven company. They're just planting their chips in far more devices than just PCs. So I think it's reasonable to project that there will be some slowdowns ahead, but 5% seemed like a good, doable yet conservative number for me. Again, I used a 5-year pre-tax profit margin based on the last 5 years, with the exception of 2016 that just seemed out of line. And again, since they're moving out of the PC business, I was comfortable excluding that year. Taxes, I used the value line estimate, which is right in line with the company's estimate, gives me a $6.31 EPS projection. Manifest is a little bit higher. I used a high PE of 15, average PE of 12, which is right in line again with the manifest 11 PE. Next slide. And that gave a potential average return of 12.2%, a little above manifest's potential return. It's, again, more than 5 percentage points above my par. So for a very high quality, solid, core, blue chip, reliable, understandable company, I thought that's an excellent return in today's market. And you've got a little bit of an upside to 16.5%, 17% if it should hit the high PE. So I decided to add Intel, and I have owned Intel over my lifetime and am considering it again, but I don't believe I own any right now. So that's my disclaimer side as well.
Okay, well, thanks, Si. Yeah, it's been quite a core blue chip company for a long time. In fact, I don't remember which one of us did it, but at the stock panel at the successful investing conference that we ran a little while ago, Intel is one of the better performing selections. It was either you or Pat Donnelly, I think, that made the selection back then.
I picked it.
Okay, and it's been doing pretty well since then.
Yep.
All right, so we're going to turn from the world of keyboards and computer chips and all that kind of stuff to what really makes the world go round: milk. Got milk? If you remember the ads. And I'd like to take us on a short trip to a place called New Zealand. It's the place where they film movies like Lord of the Rings. It's one of the most picturesque places on the planet, and it's the source of this idea. The idea is actually described in greater detail in this book by Keith Woodford. He's actually an academic / medical person in New Zealand, and talking about milk. So let's go ahead and get into it. Here's where it comes from. What I have done here is limited the field of eligible companies to companies that have a good or excellent quality rating. In this case, the companies that survived the screen are all above 80, so they're all excellent quality companies with generally pretty good financial strength and that sort of stuff. And then I sorted it by the projected return on value. The formula for projected return on value is right here. We're not going to go into it tonight, but we are going to spend a lot of time on this in the first quarter, locking it down as a parameter, depending on the results of our findings. So far, we haven't seen any flaws, and we're quite encouraged about its use in a number of different applications. In this case, just think of it as a measure of return that happens to also incorporate the capital structure of the company and all that kind of stuff. That formula in the numerator is the enterprise value. So you can see these are double-digit projected return on values. Right now, the average projected return on value for the 2,500 companies that we track is 5.5%. It starts to get special out there in the 13% range. Here's what the distribution of projected return on value looks like right now. So we are shopping for excellent companies out in this part of the distribution without getting too carried away and going too far off the chart to the high side. There's some pretty interesting studies on here. Virtu Financial, I would recommend that as a study. VIRT is the ticker. Ken's DR Horton from last month is right up at the top of that list. So DHI, hopefully that bodes well for it as a round table tracking holding. And the company I'm going with here tonight is A2 Milk Company. The ticker is ACOPF, and it's relatively uncovered by virtually everybody. There's nothing here from Value Line. There's no analysts covering it that we can call the analyst consensus. We do get one vote from the team at Morningstar, but it's virtually uncovered. One of the other things I also like is that the relative strength index is down fairly close to 30, suggesting a potentially oversold situation. So we have a high potential return prospect in combination with a pretty good company. And, milk is a pretty significant part of our lives. So maybe we want to dig into this one a little bit. Certainly not computer chips or that kind of stuff. Here's what the story boils down to. It's something that I was completely unfamiliar with until this afternoon. Keep in mind that I might have aced biology in high school, but that was a long time ago. I'm not a microbiologist or anything similar to that. I don't play one on TV. And I can't even say the words like Hugh does when it comes to chemistry and that kind of stuff. But what they're basically talking about is the fact that the production, the bovine factories known as cows that produce milk have different types of protein depending on where they're at in the world, believe it or not. And the cows that have this A2 protein, which is the desirable protein, seem to be nested predominantly in places like New Zealand, India, and some of the Far East. Now, there are a few exceptions to that. There are some Guernsey breeds that are pretty much all A2, but the problem is this A1 protein. And again, it's something that's relatively new to me and that I just began digging in on. What it boils down to is, I know a lot of people with lactose problems, other health-related problems, allergies, all that kind of stuff that can be traced back to dairy products and in many cases specifically milk. And it appears that this A1 protein is really part of the problem. Again, you can do your own research on this. What it comes down to is a mutation story. It really is. Over the evolution/mutation in American and many European cow breeds, they basically have mutated to where they have a different genome structure, which creates an interesting reaction with this, what they claim is an opiate-like chemical, this BCM7. But again, many people who have trouble with gastric disturbances, and it can extend to, as it says right here, joint and muscle pains, fatigue, headaches, all that kind of stuff. Some people actually go so far as to attribute potential schizophrenia to the situation. So it gets pretty ugly. So basically what these guys are doing, they're talking about limiting the production of milk to A2 cows and avoiding any A1 cows like the plague. And I really expected this to be potentially science fiction. It could still be. It could still be something completely dramatically wrong, but I did look at the reviews of the book. I expected to see some scathing reviews with an opinion that's out there like this. It's relatively new. It's only been in the last couple of decades that this has been going on, discovered and pursued by this company. I expected to see some really scathing rebuttals to the evidence. I went onto Twitter and a couple other places and just kind of sniffed around, again, expecting to have some fairly violent pushback. If it was, completely off in left field, I found nothing that would suggest that so far, at least. So these guys have been going at it since this phenomenon was discovered approximately 20 years ago. Again, coming out of the fields of New Zealand and Australia, and they began working at first with China, and they have developed a completely A2 product base aimed first at infant and toddler stuff in China, and they're just going gangbusters in China. They broadened their product portfolio to address some of these things, and again, there are a number of Chinese studies. The Chinese people, call it what you want. They do their homework pretty well. They do misbehave from time to time, as we found out with pulled pork a few years ago. But in the case of this, they've done their homework, and they really think there might be something to this A2 versus A1 phenomenon. It has extended into the United States. Boy, anytime you penetrate in a meaningful way the United States and China, you've got a pretty good sized market engaged. And it actually is fairly dramatic. You'll see as we take a look at what's happened. They've actually only been operating in the United States for a few years, and they've gone from exposure in the California region to a broad national distribution. It's so important. The key thought or the key concept here is once you're on the shelf, once you have that shelf space, you can begin to operate. So who's ever in charge of the logistics and the distribution spread for this company is basically got an S on their chest. Fantastic job of getting it so broadly distributed, and that continues to this day as they continue to go. Look at the chains that they have established a meaningful presence with. Anytime you're in Walmart, Target, and Costco, in addition to some of those leading individual grocers up at the top there, you're doing some good things. So these guys are positioning themselves to deliver some of this A2 milk in a very meaningful way. Again, shelf space is what really matters here, and they have locked it down, and they're in pretty good shape. Here's a look at the company from a visual analysis standpoint. Again, it's emerging. It's got a limited history, very exciting growth trajectory. Obviously, milk is milk. There has to be a saturation. No drum or pun intended there. There will be a saturation point, but there's a lot of milk and farm products / food to be sold. So a lot of available market there. Basically a $1 billion company growing at 25%, achieving 20% net margins, checking in with PEs that are actually fairly mundane for a company at this stage in its growth cycle. Call it 25. Even under those conditions, you end up with, in those assumptions, you end up with at least something in the teens, if not 20%, for a projected annual return. They do not have significant liabilities, even though they've been doing such a great job on expansion. They've got more cash than liabilities. Really cool. What little long-term debt that they have, and that's basically almost nothing compared to the total cash on hand, very attractive, and they do seem to be firing on all cylinders. This is actually a mistake, so we'll just get rid of that. So the relative strength index is down closer to 30%. So again, you have a limited track record, but this is an interesting story that I want to learn more about, but it's enough that I'd like to tiptoe into it and pay a little bit closer attention to it. Just to drive the point home, they have not been publicly traded as an ADR for all that long, but the point that I want to make is at $8.81, they're basically trading at a level not seen for approximately 3 years. And the company had a real nice jump up to this point and has plateaued. We've talked a lot during our bull sessions about the power of a plateau, so long as that green line and that growth trajectory and the blue line behave itself, that plateau or mesa can be one heck of a opportunity for a company that does continue to execute well. So I see a lot of strength of management in how this company is executing its logistics and its distribution expansion. and it's kind of hard to argue against if the science behind it and the actual effects are real. It'll be interesting to see how it takes hold, and I'm going to at least have at least one finger on the pulse of this one, and we will add it to the roundtable tracking portfolio as a non-core holding because it's obviously a early stage company. But let's go for it. And with that, Ken, I think we can close down and open up the poll.
Okay, if you give me just one moment, Mark. And here comes our poll. All you need to do, folks, is pick one of them. If it's on your computer screen, use your mouse or your finger to vote. If you're on a different platform, you have a rough idea of how you can vote. You should be able to vote whether you're on a tablet or on your phone. I'd love to get at least 90% voting. We're up to, we just hit 80%, 82%. So come on, it doesn't cost you anything and nobody knows how you voted. So help us pick another candidate to go into the portfolio. Not only will either Mark, Sy, or I put $1,000 of our stock in, but whichever one wins the vote will also put $1,000 in from the audience. I'm going to count down for about 8 seconds here. I'd love to have another half dozen of you voting yet if we could get it. And I'm going to close the poll. And it was a close one this time, Mark. Let me share the results.
How close?
We very close, 4 percentage points between A2 Milk and Adobe.
No kidding.
So I'll let you make the call, Mark. Sometimes when they're that close, we put in for each, or sometimes we just put in for the absolute winner. So you make the call, okay?
Well, I think that's within the margin of error, and I really have to go. I have to say that I hope nobody took the omnibus proposal seriously in the green room before the session. But
I actually think we should buy blank because blank got 1%.
Yeah, I don't know what was happening there. So.
That's not even none of the above. It's just blank.
Well, see, we take that and we reinsert it and assign it to one of the other ones. No, we're not even going to go there. Let's stop.
Mark, you can read the puns, Mark, in the question box. We're getting a lot of absolutely terrible puns going on right now. So.
Yeah, our audience does not disappoint when it comes to that. There's no doubt.
Mark says, Len, you milked it, okay? All right. So I'm going to close this poll so we can continue.
All right.
And
I'll just go ahead and point out that we still do not have any real firm view of what's going to be happening a few months from now. So we will be continuing to work on that in terms of physical face-to-face meetings. And gosh, we really want to have those at some point. Maybe with the vaccinations and everything, we'll eventually get to that. In the meantime, we do continue our bull sessions on Tuesdays at 2. We have been having a lot of fun with them. I think we will be kicking around Adobe either next week or the week after that, so we could have some fun there. January Roundtable will be a month from today on January 26th, a month from now. And like I said, we are starting to see a little bit of stuff. I have noticed that some of the entertainment, the Lady Antebellums or some of those, they have begun to schedule real in-person conferences for like October and November, Ken. So that is starting to happen. And
okay.
That actually carries some financial risk for them. So there must be some of their algorithms must be kicking in. So
well, we in Better Investing have an event scheduled for May. I happen to think that's a toss-up, but we'll have to see how that one proceeds as well. I think we're scheduled for the middle of May in convention down in Dallas again, so we might have to do something with that. But it would be great if we could all show up and feel safe in May at that point.
Yeah, starting a month from now, at least we'll list them as at least the probability is finite now, and it's a good thing.
Well, and
pray very hard. Pray very hard that we can make May. That's great for BI and for all of us, but I'm looking for the second week of July for something called the All-Star Game that we're having in Atlanta. So if we can be safe in May, then I feel really good about July.
That is very important, Si.
Mark, I do want to mention, because I notice we have some of our Indianapolis friends with us this evening, that we have scheduled a webinar for Indianapolis who's going to try to run a full day of education on the last weekend in March. So we'll get that onto this schedule the next time we visit you in the round table. But we will be appearing at this webinar that Indianapolis, that the Indiana chapter is putting on too.
Okay, and I guess with that, I do want to issue the reminder that if you're not familiar with it, we do put all of these sessions on the recordings or on the YouTube. YouTube.com, just search for Manifest Investing. You'll find this page. We archive all of our sessions, including the bull sessions and the roundtables and the investing conferences that we've done online. You can access them there. It's searchable, by the way, so you can search for milk in the future and find this presentation. So with that, I think we could just go ahead and again, thanks guys. I think we should be clinking glasses. I actually have water, so that's my water bottle kicking in here. We should all click and celebrate 2020 results.
I think I'm having a martini delivered in about 10 minutes, so I'll just do an imaginary clink with you,
okay.
Mark. Okay.
Well, then I will clink in your general direction 10 minutes from now.
Okay.
With something similar to a martini.
Okay.
And then a Diet Coke in your direction, Si.
Yeah, I was going to say I have pink lemonade in front of me, but yes, Diet Coke works too. So.
Happy New Year, gentlemen. And Mark, if you'll close this down, we can maybe clear out the questions fairly quickly this evening. There aren't that many.
All right, thanks, guys.